You're listening to So You Know, a finance and property podcast by Uno, Australia's online mortgage broker, where we deep dive into a single aspect of home loans so you're better informed and can make better decisions when it comes to your property and your home loan. Please remember, nothing in this show should be considered financial or home loan advice. If you want advice relating to your personal situation, email us at hello@uno.com.au or contact your Uno broker.
All right. Hi, Tim.
Hey, Vincent, how are you?
Really well, thank you. I'm glad to have you on the show. We're in person. We're in Mollymook today, which is lovely. Actually, it's not lovely today.
No, sorry about the rain.
This is not the greatest version of Mollymook that I've seen. But what are we going to talk about today?
So we're going to talk about a loan product called reverse mortgages.
Reverse mortgages, perfect. And so we're going to assume that people have heard of them, maybe know a little bit about reverse mortgages, but don't really know anything. So we're going to start, as we always do, with what is a reverse mortgage? What is the product?
Okay, so a reverse mortgage is a loan product that is available to Australians who are basically 55 years and over and are either in the process of retiring or are fully retired.
Right.
So it's a loan product where you can access the equity in your home for a whole range of various purposes. And it's super flexible. It doesn't require loan repayments.
Yep.
Which means that the applicant doesn't have to qualify any servicing calculations.
Yep.
Don't need pay slips, don't need tax returns.
Yep.
But it enables you to unlock some of that equity that's in your home for a whole range of purposes.
Perfect. Okay. And so I want to get in a little bit of some of the detail in a second, and I want to talk about who it's for in a second. But just in blunt terms, someone owns a property, presumably outright, as in they own all of it?
It doesn't have to be outright, but it just, as long as it's got some equity
in it.
Yeah.
And they're, if you like, asset rich, cash poor. They're like, I need to do something, and I've got this lovely asset sitting here, and I can't access it, but I'm probably no longer working, or maybe I'm only working part-time. So a traditional loan where it's like, all right, well, when are you going to repay it and how are you going to repay it? Those questions mean that normal kind of loan, maybe a non-reverse mortgage, I don't know what's normal these days.
Well, it's called a forward mortgage. A standard home loan is called
Really?
Forward mortgage, which not a lot of people know.
I didn't know that at all.
Exactly.
24 years in mortgages, I'm still learning. Okay, cool. All right. So it's not a forward mortgage, it's a reverse mortgage.
Yeah.
That makes sense. Was it called a forward mortgage before reverse mortgage? Just sort of like, okay, we've got to now call this something?
It was chicken and egg. So once reverse mortgages started being launched, the opposite was obviously the forward.
Right. Okay, cool. All right, cool. So we've got a thing that basically allows you to use some of the equity in your home to do something, when you're in a position and a stage in life where getting a forward mortgage or a more traditional mortgage where they're expecting you to pay it back out of income doesn't apply.
Exactly.
All right. So let's segue nicely from there to who it's for. You said over 55s, but talk to me in more general terms.
Okay, so in Australia at the moment, we've got this perfect storm of an ageing population, right? So we've got baby boomers, Gen Xers that are at that stage where they've either retired or are on the verge of retiring. So a reverse mortgage is really suited for those people that no longer work, that no longer have an active income. They may have some super coming in or they don't want to touch their super just yet, but it's designed to allow them to access the equity in their home right at this point in their life where their retirement lifestyle is the main priority for them. So they want to improve their retirement lifestyle or perhaps help out their children, etc., a whole range of reasons. But it's really designed for people in that 55 to 75 year age bracket, who may not have children, may not have somebody that they can leave their estate to, maybe that, somebody that wants to live a comfortable lifestyle now and not wait until, their superannuation or something like that. They want to live the lifestyle now.
So I've got a couple of questions on that. So it's all possible, like reverse mortgages start at 55, if I can kind of use that funny term.
Yeah.
And retirement age is typically
67 for a pension. I mean, you can retire at any age, but typically to get a pension these days, you've got to be 67.
Got it. Okay. So there's some of the motivation might be, well, I will have income coming in at some point. I don't have it now, but I'm in a state of either retirement or semi-retirement.
Yes.
And there's a lifestyle. So that might be one kind of who it's for. But one of the things that I've observed in terms of people who, who are looking at or suitable for or, kind of designed for are people who are like, I'm here in terms of my stage of life, but I'm also here physically. I'm in this house and I want to stay in this house and I like this house, but that doesn't allow me to live how I think I can live at this point, and there's a disconnect between that.
Exactly. So as you said earlier, we've got all these Australians who are asset rich, but may not have the cash flow to live comfortably. I mean, the cost of living is going through the roof, as we know. Everywhere we turn, we see price increases, power, electricity, fuel, and all the rest of it. There's no point having this massive amount of equity in your home if you're not living comfortably.
Right.
Like, what is the point?
Right.
Like, so you've either then got to make a decision, well, do I downsize? Do I get out of this house into something smaller and a bit cheaper to free some cash up?
Yeah.
Do I dip into my superannuation? Well, I don't want to do that just yet because I'm only 55 or 60.
Yeah, that might be tax impacts of doing
Tax
that.
impacts, like what can I do that to give me some cash flow at this stage of my life that doesn't involve me moving, doesn't involve me selling, doesn't involve me trading to something smaller?
Yeah, well, that whole I want to be here, I don't want to be somewhere else, and I don't want to move or I don't want to sell and then have to buy again. No, I mean, yeah, it's a hassle, but I'm also thinking there's a whole bunch of switching costs associated with it. Let's say you grew up in a particular area, you raised your kid. I think about my parents, right?
Yep.
They grew up in Sydney, but they ended up in Perth, and they live in the family home where they raised their kids, and they're happy there. I mean, it's way too big for them, obviously, but in terms of the amount of pain and angst and concern, just ignoring the cost that it would require for them to move if they needed to access what that house is worth is one thing, but also if they did, I mean, even downsizing by, to a third of what they have, in Perth, it'd be 30 or 40 grand worth of stamp duty.
Of course.
And so they're like, well, that's just dead money to just do it. So if some of this is like bridging the gap between where you are now, where you want to get to, but also the reality of the other options is that they're actually pretty expensive.
Absolutely. That's one of the drivers of reverse mortgages is the idea that you can never be evicted from your home. Right. Like you can never. I mean, there's two things. You can never be evicted from your home. I mean, the idea is that you are to stay in your home until the day you go into aged care or pass away.
Yep.
And the other thing is that you can never owe more than the house is worth.
Right.
Because there's safeguards and checks and balances in place. So they're the drivers. So people want to stay in their family home, but unlock some of that equity to enjoy a comfortable cash flow and a comfortable lifestyle.
Yeah.
That's what it's all about.
Yeah.
That's what they're targeting.
Perfect. Okay. And then you've kind of opened, I mean, it's one of those things where you said, well, what can you do if you take on a reverse mortgage, what can you do with the money? Technically, quote unquote, anything. But tell me the top 3 to 5, maybe even 6 things that people tend to do with that capital for people who are like, oh my God, I didn't realize I could do that with it. Give me some of those examples.
Okay. So the most popular ones are things like renovations to the house.
Right.
So you've been in your house 25 years or 20 years. You've never spent that money on the kitchen that you wanted to.
Right.
Bang, straight away, 30, 40 grand on a new kitchen.
Great.
Very popular. Second one is the old world trip. People that have worked their whole lives and said, I've had enough. We're going on a trip. I need 30 or 40 grand.
And then they come back and they're like, oh my God, I'm never doing that again.
Never doing that again. Tick. It's on the bucket list. That's been done. So big family, a big holiday with the partner.
Yeah.
And the other issues very popular lately, especially with the housing market the way it is at the moment, is a lot of couples are accessing a reverse mortgage so that they can give their children enough as a cash deposit for them to buy a house. So they're kind of giving them their inheritance now rather than waiting for them to pass away. That's also
the term for that. Is that right? Is it a living inheritance?
So living inheritance sounds good to me. Yeah, it sounds exactly right. But there's lots of other reasons for a reverse mortgage which are really popular.
Right.
Medical care. If one of the applicants, husband or wife, needs ongoing medical care, you can draw that down.
Ongoing specifically, or even just
or one-off,
whatever.
Ongoing or one-off. Medical care. You want to update your cars. You want to buy that new car that you promised yourself all these years. There's a whole range of things that you can spend the money on. To the credit of the lenders that are doing reverse mortgages at the moment, you do have to have as part of the application process, you do have to have a valid reason.
Right.
You can't just say, I want $50,000 to go to the casino, or I want it as emergency funds in case I ever need to do something. You need a reason to launch into a reverse mortgage.
Any reason you want, as long as it's a reason rather than I want the cash sitting there.
Well, and these days,
a good dog comes up at the races.
Well, it's all about responsible lending these days. As you know, with ordinary home loans, with standard home loans, it's the same rules for reverse mortgages.
I want to come back to something you said that kind of leads me to I don't want to talk about compliance, but I do think if anyone's been around for a little while and has maybe thought about a reverse mortgage in the past or heard of them in the past, and then like, where did they all go? And now they're kind of back. What happened, and like, how is it different now versus maybe what it was like 15 years ago when they sort of first came out?
Okay, so the history of reverse mortgages previously, as you say, going back a while, there were only a couple of providers in Australia, and they were largely, from what I understand, largely unregulated.
Right.
So they were kind of doing their own thing and running their own show, and not the lenders that were in the market. I've got to be careful the way I rephrase this, but they weren't too reputable.
Right.
So a lot of the interest rates that were being charged and some of the practices weren't entirely bona fide. So what happened is, part of the Royal Commission that we experienced a few years ago is the reverse mortgage industry now is probably the most heavily regulated loan product that's available in the market today. So ASIC, ACCC, AFCA, everybody watches these lenders very closely to make sure that they're doing the right thing by the clients or the applicants. In fact, as part of the application process, you have to get legal advice,
Right.
which no other loan product in Australia requires. So you have to sit in front of a solicitor and be told the positives and the negatives about a reverse mortgage. And if you still want to proceed, then we go to application.
And is it I know we're a little bit into how you get one of these, which I think is worth, but is there a financial planning lens to this? Obviously, a broker's not providing financial advice or financial planning.
Correct.
But is there some onus on the client to do that, or for the lender to do that? Like, in some respects, it's a decision around what you're doing with your wealth. Like, how does that?
Well, it's something that can come out of a financial planner's advice, obviously. Right. But the great thing about the lenders that are the major players in Australia today, as part of the interview process, they will ask you as an applicant, do you understand what you're getting into? Have you spoken to a solicitor and got independent legal advice?
Right.
And all the disclaimers are there all through the process, right?
Got it.
There is no way in this day and age that anybody can be forced into a reverse mortgage.
Right. And so just understanding there was two things in there which I think bears repeating. One is you can never owe more than the value of your home.
Correct.
So you're never going to have a negative equity situation.
Correct.
And that's legislated? Well, that's just how it's panned out.
It's the way it's panned out. It's not specifically legislated, but I'll explain in a minute how they work out how much you can borrow.
Right.
And you'll see once I explain it that the numbers are really low.
Right.
Percentages are really low.
Got it. So there's basically room in there.
Yeah.
And then the other thing, so the two things that they're not mandated, but they are essentially features of every reverse mortgage lender and product that are out there. One is you can never owe more than the value of the home.
100%.
And then the second one is you can never get evicted from your home.
Correct.
So let's talk through some of the structure of what's actually happening in a reverse mortgage. Let's use an example. I'm 59. I'm not. I'm on my way. And I have a property worth $1 million.
Yes.
And I want to do some things. I want to renovate the house and take some money out. Talk me through what this structure looks like and like some of those upper limits that you kind of mentioned.
Sure. Okay. So it's really, really simple, and it's really easy to calculate. So let's say, for round numbers, we've got a house that's worth $1 million and you're 59 years of age. So the way the lender works out the maximum that they're going to lend to you is they take your age, or the age of the youngest applicant. Yep. So if it's husband and wife, let's say 61 and 59.
Yep.
So we'll take 59. They take the age of the youngest applicant and deduct 40.
Okay.
So 59 less 40,
yep.
19%.
Right.
So that is the absolute maximum that lender will lend you on that house. So $190,000, right?
Okay. Right.
So now you don't have to take $190,000. That's the ceiling. So you could take out 5%, 10%, 15%, but 19 is the max. Now, if you think about the maths behind that, you have to to go from 19% to 100%.
It's going to be 140.
Well, that's it. You're going to be exactly right. You're going to be having 140 years old. So it just doesn't work in Australia. Nobody's ever got to that stage. Obviously, with 70-year-olds, 75-year-olds, 80-year-olds, the percentage does creep up. An 80-year-old will be borrowing 40%.
Yeah.
But over time, I mean, they're not going to outlive to the stage where the 40% is going to be anywhere near what the max.
Yeah, I mean, a property would have to drop by 60%. And then presumably when you get one of these, you don't just go, hey, my place is worth $1 million. So like, yeah, we'll send someone around to make, like, there's a valuation done.
Absolutely up front there is. Now, don't forget, as the reverse mortgage goes on year after year after year, you would think the value of the property is going up.
Yeah.
You would think. And so let's look up in 5 years' time, instead of $1 million, it's suddenly worth 1.1, 1.2.
Right.
Your estate or you are going to keep that increase anyway.
Right, okay.
And the bank is still capped at that 190,000.
And so mechanically here, we've got 109. Let's make it easier for that other. So let's say I'm 60.
Yep.
We've got a $200,000 loan, and typical interest rate on these things at the moment, around 9 or 10%.
Late eights, actually.
Late eights, okay.
Yeah.
Just again for my maths, 10%. So we've got a $200,000 loan, and it's just gonna be. Tell me how the payments happen, because you're not paying it out of your pocket.
Well, you're not making any loan repayments at all, and that's the big selling point about a reverse mortgage. They don't ask you for any loan repayments at all, ever. You can make loan repayments and principal reductions if you ever come into some cash.
Right.
You win the lotto, so let's pay some money off the reverse mortgage, but they don't typically ask you for loan repayments. So what they do is every day they work out what the balance is that's owing, that you've drawn down, not the approved limit, but actual money that you've drawn down.
Yep.
And in that example, if you've got $200,000, you may have only used 50.
Right.
So you only pay for what you've used. They work out a daily rate of interest, and then once a month they work out the monthly interest and add it into the loan.
Right. Okay.
So you might look at it this month, it might be 50 grand. Next month, it might be 52.
Right.
The month after that, it might be 52.
Yeah.
Like whatever the numbers are, I don't know what the numbers are.
Yeah.
But over time, the interest just gets capitalised into the loan.
Yeah. So it's like an interest-only loan. You're not trying to pay the principal down.
No.
And the interest is added to the loan that you had.
Yep.
And then that will go up by, 9% a year, let's call it. And so your loan creeps up over time. And then at the end of the process, like you sell the house, presumably, or you leave this mortal coil, whatever the best way to describe that is. It's the reality. We have to
all go into aged care.
All go into aged care. You go into some position where you're, like, any of those trigger it, presumably.
Correct.
And then that basically triggers a sale of the property and a recovery of their loan.
So if it's a straight sale, you've got to pay the lender out straight away from the proceeds. But if you go into aged care or pass away, you've actually got a window, a time frame.
Right.
I think it's up to 12 months to settle the loan once the estate gets rid of the house or takes over the house.
So when you go into aged care, you have to sell your house? Or
no, you don't have to. You don't have to. But
so
somebody has to take over that mortgage in a traditional mortgage. Right. Or if you do decide to sell the house, obviously you've got to pay that.
Got it. Okay, cool. All right. So essentially the aged care triggers it, because unless someone's like, hey, I'll keep paying that.
Exactly.
Or I'll refinance it out.
Refinance it. Yeah. If one of the kids want to take it over and live in it, they just get a standard home loan, pay out the reverse mortgage. One thing I should add, which we haven't spoken about, is with this reverse mortgage, when you decide how much you want, you don't have to take it as a lump sum.
Right.
A lot of people take it as like a monthly pension.
Yeah, right.
Like pension type arrangement. So you could take $3,000 out a month for the next 10 years, if you like.
Right.
You don't have to take it as a lump sum.
Yeah.
Very important.
Yeah, that's super important. And it's almost acting like a line of credit that's interest only.
Absolutely. 100%.
And those are all buzzwords for mortgage industry, but almost like it's like a big 9% credit card in some respects until
100%
you change your situation.
Exactly.
Aged care.
And now the great thing at the moment, there's now some competition in the market amongst these lenders. There used to be only one or two that did it. Now there's half a dozen, and they're all starting to get really flexible on their reverse mortgages. So they will allow you to take a reverse mortgage on an investment property, as an example. There's one lender that will do that. There's
as in you own the property. Yeah. It is an investment. And you're like, well, why would it matter if it's my own home or if it's an investment property?
Exactly. So, but they do tweak the percentage, LVR slightly, but that's okay. And there's even one lender at the moment that will allow other people family to live in your owner-occupied property and still do a reverse mortgage.
Yeah, right.
So it's a really flexible industry at the moment.
That's really interesting here because I think you're right. Like 15 years ago, it was, and if you have your knowledge or understanding of the product is from 15 years ago, it's no longer current.
Totally different.
Highly regulated, and there's some level of competition, and it's quite refutable. Whereas previously it was meh.
Yeah, it had a really bad reputation.
Yeah, but for good reason. I think
it was.
These things have to mature and have to have the right controls. So I want to segue from that to, like the question I'm always asking with these products is how to do it well and how not to do it, and those things are related, so you can talk about them in the same breath.
Well, let's look at somebody who's in their late 50s, right? And they're sitting there thinking, right, I'm at that stage now, I'm really seriously thinking about retiring and giving up work. Now, they've got a decision to make. Do they go into the whole superannuation thing?
Yeah.
Do I start pulling the super down, or do I leave that alone and maybe use the equity in the home is the way to fund my lifestyle? And we're seeing more and more people leaving their superannuation alone to build up and to grow and access the equity through these reverse mortgages.
Right.
Now, just having said all of what we've said today, keep in mind that if you're worried about your family and the inheritance that they're ultimately going to get once you pass away, keep in mind that these loan ratios are so low. Like as we just said a minute ago, 20%. Even if you add the interest in for 10 years, 15 years, they're still going to walk away with a sizable chunk of equity in their inheritance, right? So that needs to be said as well.
Yeah.
Some people get a bit anxious that they're going to die and the house is going to be worth exactly the same amount as the reverse mortgage and there'll be nothing left for the kids. It's never like that.
And when someone goes to undertake one of these, coming back to this kind of to do it well, do it badly, one of the things we always say is like run the numbers. Is it a case of when you sit down and talk to the broker, you'd be like, okay, well, this is what we need. This is what we think our house is worth. Great. Let's check both of those numbers. What happens if, it's 10 years before I move into aged care? Like what might that look like? You run those numbers and it's not a projection. It's not a guaranteed return on your property, whatever, but at least says, look, if the property keeps appreciating at 3 or 4% per year, which is long-term historically what property's done probably on the conservative side, and the loan is, 9% interest, call it, and getting capitalised, your $200,000 loan will ultimately be X and Y. Is that part of what you're doing?
Spot on. So part of the broker's responsibilities, again, and part of his compliance nowadays, is that we must give the client a projection and a chart or a graph that shows what the balance is going to look like on the loan, on what they want to do, in line with what they want to do, but also shows the value of the property in line with that reverse mortgage.
Right.
So they've got a 10-year, 15-year and 20-year snapshot
Yep.
in PDF format showing them exactly what the two balances are going to do, the balance of the reverse mortgage and the value of the property. So you have to give that to the client up front.
Right.
So and the lender will actually double check that the broker has given them that chart.
Right.
So, there's no grey areas. The client needs to go into these things with their eyes wide open.
Yeah. And so this doing it well is, firstly finding a good broker. That's why we're here. Don't need to put a plug in. We know why we're here. But also, the nature of the way these things are regulated means that if you're working with someone who's accredited, what I've observed is the accreditation requirements on the broker to be able to even sell this product are much higher, from what I can tell, than just a standard loan. And the industry regulation is pretty tight generally, but in regards to the specifics around how this product works, who's it for, if someone is able to offer this product to you, it means they've already gone through a whole bunch of hoops to be able to do that.
That is so right. That is so correct. And the just to get accredited with these reverse mortgage lenders, there's a process, a due diligence that you've got to go through. Having grey hair really helps because I'm in that demographic. But I've been doing this 38 years now, and I had to tell the lenders, explain my experience and what I'd been through over the last 38 years. Just to get a foot in the door.
Right.
So that's how strict it is now. Right. And they don't hand out accreditations to everybody.
Right.
So I'm very fortunate in that regard. But I'm glad that the industry has now been cleaned up.
Yeah.
Because it was...
it's a great product if it's done properly. And
exactly right. And used intelligently. Like the whole thing with debt, as everybody knows, is you use a little bit when you need it and you use it intelligently, right? And you don't abuse it. But I just like looking at my own personal situation. My wife and I, we don't have children.
Yeah.
And I always remember a very smart guy told me one day, he said to me, Tim, you don't want to be the richest guy in this graveyard,
Right.
which is true. Yeah. Like, why do I want to die with all my assets tied up in the house or my car or whatever?
You got to live.
You got to live, right? And why not have a comfortable retirement by tapping into the equity in your home?
Yeah,
I think it's so important.
And in some respects, the whole point of investments is to unlock a financial freedom. It's just that if you've made some return, especially over an extended period of time in bricks and mortar, you can't sell one brick, and you can't take one brick down to the bakery and buy a coffee and a ham and cheese croissant like I tried to do earlier today. Not with a brick, but I did try to buy one.
Yeah.
So amazing, awesome. And then one that, like, we kind of invert it, but what's doing it? What not to do? Like, what's the thing you should be? Just make sure you don't do X or don't do Y. Or these are the one or two traps I see people thinking or not realizing or whatever. Like, what's the alternative?
Well, the big thing you've got to avoid, which does happen, some people get very caught up in the emotion. Like, I'm 75 years of age.
Right.
Take the 40 off, so that means they can take 35% of the house. Great, let's take it all.
Right.
On day one, let's take 35% of the $1 million house, 350 grand. It's like, why? Do you need 350,000? You don't need 350,000. Take what you need, because you're going to be paying interest on it, right, from day one. So,
and also once you use that equity, that is gone.
It is gone. It is gone. So just be very mindful of that you only take what you need. There can be Centrelink implications with regards to certain situations, client situations or applicant situations. So check with Centrelink before you take a reverse mortgage. If you're getting a part pension now from Centrelink, you don't want to put that in jeopardy. You don't want to affect your part pension.
Yep.
So to me, a reverse mortgage is a debt instrument. So it shouldn't be treated as income because you're actually going into debt when you're drawing it down. But Centrelink should give you some advice in regards to your personal situation.
Yeah, and my follow-on from that is if you make a move that involves assets and debt and income, there may be tax implications as well, not necessarily related to the reverse mortgage itself, but to the activities that you're undertaking, whatever those things are. And so it's the kind of thing where especially if the numbers are, I mean, I guess for everyone they're quite significant, but if you're in a position to, get wealth advice and or tax advice, it's not a given, but it's
super encouraged. Really encouraged. And also have dialogue with your family.
Right.
So if you've got grown-up children, have dialogue with them, tell them what to expect.
Right. Spending it all.
Yeah. You're not going to get a $2 million house. You might get 1.5 million or something like that. So you've got to have dialogue. And
it's funny that you say that. Like, my parents are in their 80s, and they've got sons, and their sons are all doing fine. And just trying to get my parents to be like, just we don't need it. You do it. You do the thing. Like, it's lovely, great. It'll help, obviously. I'm not being silly, but like, I want you, make sure you're not limited. But what's funny, I mean, my parents, born in 45.
Yeah.
Like, they're birds. Like literally, like, they're not meaning that in a disparaging way.
Yeah.
But their reality is, just be careful, and they're very measured and conservative, and like even trying to get them to leverage what they've got. And it's funny. It's a mindset shift. I'm not really sure it can happen.
Well, the other thing that goes with Australians, right, in the way we think, we like to pay everything off, pay the house off, pay the car off, pay the thing off. So that's slowly changing now, I think, with Australians. I think, the idea of paying off a $2 million house but not being able to put bread on the table because you've got no money, that's starting to die out.
Yeah. It's interesting. That's an interesting note to leave on as well. Okay. So any last closing comments on reverse mortgage before we wrap it up?
I just want to say, the only thing I would say, the reverse mortgage has come a long way in 12, 15 years. It's going to be the boom product of the next 10 years, in my opinion, given the circumstances with baby boomers and Gen Xers and the real estate market as we know it. I think If you're going to launch into a reverse mortgage, talk to someone like myself or one of the brokers. Get some good advice from your own accountant. Get some good advice from your financial advisor if you've got one.
Yep.
You're going to need legal advice at some stage anyway.
Right.
If you need to talk to Centrelink, talk to them as well. Go in with your eyes open. Go in with your ears open. If you still want to proceed, then talk to someone with a bit of experience and grey hair.
Perfect. We'll leave it there today, Tim.
Thanks. It's good to see you, mate. Thank you. Thank you.
Thanks for listening. If you have a topic you'd like us to cover, just email us at hello@uno.com.au. If you'd like your current home loan or next home loan taken care of, just reach out to your Uno broker or email us. That email again is hello@uno.com.au. If you enjoyed this podcast, please leave us a review.